TD Bank joined some of the other big banks in this country in beating expectations in the most recent quarter. A big part of the reason, lower set-asides for bad loans moving forward. TD's President and CEO, Bharat Masrani, joins us now. Thank you very much for being with us. And I do want to start there because there's so much of what you do on both sides of the border that gives us insight into how everybody's doing. Why the picture on loan loss seems to be improving across the board at the banks. What are you seeing that gives you comfort that you don't need the levels you had last quarter?
Well, we built up a huge amount of reserves. By the way, Amanda, nice to be seeing you again and hope everything is well. On loan losses, we built up a lot over the past couple of quarters. And as you know, under the IFRS 9 regime, we use modeling and then we have a judgment layer over it. And when we look at, the level of reserves we've built, we feel comfortable that, that we are at a good spot here. We are still building reserves on performing loans, as you probably saw in our numbers. But the economy is opening up. We are not in as dire a strait as we were in the springtime. There are pockets of, issues still. But generally, things are moving in the right direction. And that gives us the confidence that, the level of provisioning we have is adequate.
And that is even under the assumption that we're heading into, as we see this second wave, and there will be, weeks, perhaps a couple of months of some tough times.
Yeah, a lot of uncertainty still. There's lots of puts and takes here. On the one hand, there's some good news, good developments on the vaccine front, on treatments and the like. But as you rightly point out, there is a second wave, and some numbers are quite horrific. And so we'll see how all that plays out. But generally, given where we are, I'm cautiously optimistic for the next year here. There are, yes, lots of headwinds, like you say. We still have a long way to go before we get a recovery or, frankly, get off the pandemic onto the other side. But I think, we are moving towards a more positive outlook than what we've seen over the past 7 or 8 or 9 months.
Can you make a comparison for us between your U.S. business and your Canadian business in terms of what you're seeing in the quarter?
Well, in Canada, we've seen certain asset classes do exceedingly well. The housing market, strong mortgage business, of course, our deposit business, which you've seen in all the banks, is extremely strong. And, we maintain our leadership in those areas. In the U.S., our card usage, I'd say on the debit card usage, we're seeing activities, generally what I'd call business as usual. There is softness on the credit side. As you know, we are on the eastern seaboard, so obviously, that may not be reflective of the whole economy in the U.S. But we're seeing pockets of growth that have come back, and that's good to see. And I think that is reflective of, the gradual reopening. And yes, with the second wave, there is, without a doubt, lots of concern. But even the closures and the lockdowns appear to be, quite local and confined to specific areas rather than going through a general lockdown right through the economy.
Do you feel as though, and I understand that you probably recalibrate as you go, but do you feel as though the bank has seen, both in Canada and in the U.S., the worst of what will happen to your small business clients? In other words, have we seen it yet, or is that still something that you'll have to absorb later on?
The effects of such an event, what a tragic crisis, will be felt for many, many years to come. So I think it's premature to say and start declaring victory, notwithstanding my comment that we're seeing, more green shoots than we did a few months ago. But it doesn't mean, we're out of the woods yet. A lot of uncertainty out there. And without a doubt, with such a crisis, there will be a slowdown. There will be, lots of time required to repair the economy. And that means, unfortunately, that there will be impacts on certain businesses, small businesses particularly, as you said, because they've felt it the most. And when you have a forced lockdown, it is an extremely difficult situation. So I expect it will be a longish recovery time than perhaps, what all of us were hoping and wishing for.
We have seen, record amounts of government support, and we know some of it administered by the banks. We see the new, they've just re-upped on the business loans, another $20,000, $10,000 forgivable. What has that meant for the banks in terms of being in touch with your clients? I could see that being a benefit to you of having closer contact at this time, but also higher costs for you in administration and the like. I mean, what's the sort of trade-off of managing through that?
Oh, but I think it's a good program. It was absolutely needed by the small business sector, and I think from an administration perspective, obviously anything of that magnitude and at the speed with which the banks were able to put this in place, and of course there's some difficulty. But I think overall these programs have worked quite well. The much needed support was required, and I think this comes some ways in helping small businesses. So very happy with how the programs have run to date. And I know this additional SEBA, is the business account, as you rightly point out, will be welcome, by the small business folks out there. Now, there's always this issue as to how long this help will last, because some of the issues and some of the difficulties faced by that sector are very profound, and I know there's a huge amount of difficulty out there.
When we look at the something else that is a trend in the banking sector in Canada, your capital levels, Tier 1 ratios, extremely high, and I think we can show it. And in fact, hitting levels where because you can't do buybacks or up your dividends here, some have suggested it may actually prompt some other strategic moves, deployment of capital for acquisitions, for instance. Is any of that on your mind right now?
Okay, getting into a crisis of this magnitude and there were so many unknowns, I think it is good. And from TD's perspective, we entered the crisis in a strong position. And frankly, given all the uncertainties out there, I feel comfortable that we should have strong capital levels, and we do. It gives us a tremendous amount of flexibility to absorb even more difficult issues that our clients might encounter over the near term or the medium term. On top of that, it allows us to participate in the economy and make sure that we are allocating credit where it is appropriate and needed. And having strong capital levels, having a strong banking system certainly facilitates that. And it also allows us to invest. And we have lots of, organic strategies, and we continue to invest to make sure that we are there for our clients with the right offerings, right products, with the right digital properties, and all that takes investment. And I think to have strong capital levels is very useful. And finally, I know I've been asked this question many times over the past couple of days. What about inorganic? What about M&A? And from TD, we've been very clear. Yes, we are interested should a compelling opportunity present itself. We certainly have the capability. We've shown it. Our history has been, particularly in the U.S., but even in Canada, to grow our business, through acquisitions as well. So should a compelling opportunity come up, of course we'll look at it very seriously, and having strong capital levels allows us that flexibility.
I mean, you've indicated in the past that your growth in the U.S. will be both organic and non-organic. So can we assume that there is a kind of a constant watch of possible targets down there?
It has been for many, many years. But it has to be compelling. And what I mean by compelling, it has to make strategic sense, financial sense, timing sense. We are a bank. Risk is very important to us. Culture is very important. So we have to look at the overall opportunity, and like I said, should there be any compelling situations that arise, then we would look at it very seriously. I would say that in our history, at least I can say from a TD perspective, whenever we've had major dislocations in the market, there have been more opportunities. So we'll see. It's early in this particular crisis. We'll see. What plays out. But to have very strong capital levels, a strong balance sheet, and strong reserves, frankly, given the type of crisis we have, are all helpful as we move forward.